Hey there guys, welcome to the channel. Thank you so much for stopping by. My name is Christian Cariello. I'm a real estate agent based out of San Antonio, Texas. And today we have a pretty interesting topic on our hands. Today we're going to be discussing FHA versus conventional loans. So let's get right into it. Let's get started with an FHA loan. An FHA loan is a government-backed mortgage insured by the Federal Housing Administration. One of the biggest misconceptions with an FHA loan is that it's only for first-time home buyers, which is not true. You could actually already own a home, look to buy another home, and use an FHA loan if you wanted to. A lot of the times first-time home buyers will associate themselves with this loan because, it is a great option. The reason why an FHA loan is very popular with first-time home buyers or anybody in general is because lenders offer much easier qualifying terms versus a conventional loan. So let's get started with credit. With a 580 credit score, you're going to be able to secure yourself a low down payment, 3.5% that we're so used to seeing with FHA loans. Now, if your credit score is lower than 580, there are some lenders that will approve you with a credit score of 500 to 579. Now, do keep in mind, if you do get approved for an FHA loan with a credit score between 500 and 579, you're going to have to come up with a 10% down payment versus 3.5%. Next, let's talk about debt to income ratio. So first, let's go over what debt to income ratio is. Debt to income ratio is your monthly debt payments divided by your gross monthly income. So for example, if you have $2,000 that you have to pay towards debt every single month, that could be a car loan, could be a mortgage, could be a rent, could be credit card debt. If you're paying $2,000 a month for all those things and you're making $4,000 a month, your debt to income ratio is going to be 50%. With an FHA loan, a lot of lenders will approve you up to a 50% debt to income ratio. There are also lenders out there that will approve you of a debt to income ratio of up to 57%. Now let's talk about mortgage insurance. When talking about an FHA loan, mortgage insurance is referred to as MIP, mortgage insurance premium. There are two different kinds of MIPs when it comes to an FHA loan. There's an upfront MIP and there's an annual MIP. Your upfront MIP is going to be 1.75% of the loan. So for example, if you have a $300,000 house, you're putting 3.5% down, which is $10,500. Your loan is going to be $289,500. Now, to get the upfront mortgage insurance premium, you're going to multiply the loan times the 1.75% rate, which in this case is going to give us $5,066. Now, that amount can either be paid upfront at closing or it can be rolled into the loan, whichever one works best for you. We also have the annual mortgage insurance premium. Usually, if you put 3.5% down, credit score is around a 620, you're going to be looking at a rate of 0.85% of the original loan. Let's go back to the loan. $289,500 multiplied by the 0.85% MIP rate. That's going to bring us to an annual MIP of $2,460. Divide that by 12, you're going to get $205 that you're going to be paying per month on top of your monthly loan payment. Now, the MIP is going to remain for the entirety of the loan unless you put down 10% or more. If you put 10% down or more on an FHA loan, you're only going to have to pay MIP for the first 11 years of the loan. After those 11 years, MIP falls right off. Now let's get into the appraisal. Although it is easier to get approved for an FHA loan, the appraisal part is going to be a lot more strict than that of a conventional loan. The FHA appraisal procedure is designed to ensure the safety and the soundness of that property. So although the value is important, an FHA appraiser is going to be more concerned about the safety of the property. If the home that you're purchasing with an FHA loan has holes in the roof, visibly bad foundation, exposed wiring, or anything of that nature, that loan will be subject to repair. Once those repairs are taken care of, you're good to go. Now, some key notes when talking about FHA. Whenever you're using an FHA loan, the property needs to be your primary residence. You cannot buy an investment property using an FHA loan. The property you are purchasing has to be your primary residence, correct. But after 1 year of owning the property, you are free to do as you please. So after 1 year of ownership, you are free to rent it out, fix and flip it, secondary home, vacation home, whatever it is you like. Now, an FHA loan is not only for single family homes. You could also purchase a 2-unit, 3-unit, and a 4-unit property with this loan. You would still have to occupy one of the units while renting out the others, which is also known as house hacking. Now let's talk about the conventional loan. So a conventional loan is funded by private lenders. It is not backed by the government and it is not insured by the Federal Housing Administration. Now, a big misconception with a conventional loan is that you need 20% down, when actually you can put down 5% and even as little as 3% down. Now, 3% down conventional loan is also known as a conventional 97, which is only for first-time homebuyers. If you are not a first-time homebuyer, you cannot qualify for a 3% down conventional loan. So in some cases, a conventional loan may even be a better option for first-time homebuyers over an FHA loan. Now let's talk about credit. When it comes to a conventional loan, you're going to need a credit score of 620 or higher. If you have anything less than a 620, there are some lenders out there that will still lend you the money, but you're going to have a higher interest rate and a higher monthly payment. Debt to income ratio. So with a conventional loan, your debt to income ratio can be as high as 36%, and some lenders will even lend up to 43%. So mortgage insurance. Whenever we're talking about a conventional loan, mortgage insurance is referred to as PMI, private mortgage insurance. So with a conventional loan, there is zero upfront mortgage insurance due versus an FHA loan where there is. Now there is still PMI if you're putting down less than 20%. So for example, let's use $300,000 sales price once again, putting 3% down, that'll be $9,000, which will leave us with a loan of $291,000. So your PMI rate is gonna be highly dependent on your credit score along with how much you're putting down. So let's just compare apples to apples as we did with FHA. We're gonna use a 3% down payment along with a 620 credit score. With those two factors, our PMI rate is gonna be about 1.85%. We're gonna multiply $291,000 times 1.85%, which is gonna cost us $5,383 a year. Divide that by 12 and our PMI is gonna be $445 a month on top of our monthly loan, which in this specific scenario is double that of the FHA mortgage insurance. Again, I wanna reiterate, if you have a higher credit score and are putting down more money, your PMI rate is gonna be significantly lower versus a 1.85% PMI rate we just used. PMI can actually be canceled once you reach 20% equity in the home. That could be as quickly as next year, the year after that, 3 years down the road. But once you reach that 20% equity mark, call up your lender and tell them to take off the PMI and you are done. You can actually avoid PMI altogether with a conventional loan if you put down 20% right off the bat. Zero PMI, lower monthly payments. Now for getting an appraisal with a conventional loan. It's easier to get an appraisal approved through a conventional loan versus an FHA loan. And that's because with a conventional loan, it is more focused on the value. Now, that is not to say that they don't care about your safety or the soundness of the construction, but again, it's more based off of value. Now with a conventional loan, it does not have to be your primary residence. It could be a secondary residence, it could be a vacation home, it could be an investment, fix and flip. Now the only exception, remember the conventional 97 loan we were talking about earlier, the 3% down conventional loan. That loan is specifically for first-time home buyers. So yes, it has to be your primary residence. But if you are putting 5% down, 10%, 15, 20% down, it does not have to be a primary residence. Now those are the main differences between FHA and a conventional loan. Now you're probably thinking, which loan is best for me? There are so many moving parts, there are so many variables that go into getting these loans that you're going to have to talk with a lender or a mortgage professional. But again, if you are wanting to crunch your own numbers, you're going to want to talk with a lender. If there is one thing that I will suggest, highly suggest, is that whenever you are looking to buy your next home and you're trying to determine whether FHA or conventional is a route you want to go, you're going to want to talk to multiple lenders. You're going to want to shop your rate. Not every lender is the same. Some lenders can offer you better rates. Some lenders will allow better debt to income ratios. Some lenders will allow this credit score, that credit score. And that's why I say talk to multiple lenders, because there are plenty of options out there for you as a buyer. Again, thank you so much for stopping by the channel. I hope you guys found this information very helpful. If you have any other questions, feel free to reach out anytime or comment down below and I'll reach out to you as soon as possible.